Okay, let's go ahead and look at what it looks like when you have a discount on a bond issuance. In other words, you need some money. For example, here we have Sonic drive-ins. They need $2 million, so they issue a bond that pays 5%. Notice that this is on July 1st, and it pays interest. In other words, you're going to be forced to pay interest on the 1st of January and on July 1st. And it goes for 10 years. Before we get started, let's remember what a bond is. So a bond is literally a piece of paper. Let's go ahead and draw a piece of paper here. And this bond is going to say on it, oops, wrong button. It's going to say $2 million, 5%. So let's go over here and it'll say $2 million. And it'll say 5% on it, on the face of the document. And in this case, it's going to pay interest. And it pays interest on 1/1. And I believe, yeah, 1/1 and 7/1. So let's go ahead and I put this up here so you know this is how it works. Okay, so this is what you have, and it'll say something really fancy on here. It'll say Sonic, and Sonic is looking for someone to buy this piece of paper, and the piece of paper basically says, "Hey, I'm looking for $2 million. I wish you would give me $2 million. In exchange for that, I will give you 5% interest." Remember, every time we say 5% interest, we want to finish it with per year. Okay, 5% per year. And it's going to pay interest on the 1st, whatever is due then, and on whatever is due on July 1st. Okay, and this piece of paper is actually, you go out there in the market and you start looking for people that are willing to pay it. Well, if interest rates happen to be right on the money, 5%, then people will give you $2 million for it. Okay, because it's, you get 5% on $2 million. If interest rates are higher, if they can just forget about your paper here and go across the street and get a piece of paper that says, "Hey, I'll pay you 6%. In other words, somebody else other than Sonic says, "Hey, I'll give you a bond," and the bond will say 6% on it. If their bond says 6% on it, okay, why would they buy yours? Why would they want this piece of paper that pays 1% less? Well, the only reason they would be willing to do that is if they didn't have to put up $2 million. In other words, if they didn't have to give you quite $2 million, if they could give you less than $2 million and still collect 5% interest, then these two products could compete with each other. And then you would be able to unload this piece of paper and get some money. That's a discount. Okay, when the interest rate is higher, this piece of paper will sell at a discount. Now, alternatively, let's say, for example, forget about this. Let's say it's not 6%. Let's say that the going rate across the street is 2%. Okay, so interest rates are currently 2%. And this bond, which is the best you can do across the street, is 2%. Well, if that party that wants to give you money or give someone money can only get 2%, then your piece of paper, okay, starts looking really valuable, because your piece of paper in exchange for $2 million will pay them 5%. This is an example of a premium. Okay, a premium is that you are in the driver's seat now with this piece of paper, and you don't have to take $2 million. Okay, you can get more than $2 million, right? And that more than $2 million that you get, 2,400,000, whatever the magic number is, that more that you can get, that premium you can get, is because your piece of paper says 5% and the outside world can only give them 2%. Okay, so this is an example of a premium, and this is an example of a discount. Okay, let's get back to our problem now. Our problem says the bond issue is $2 million, 5%, whatever. It's issued at 95.5 on July 1st. What this means, okay, 95.5 means that you have this last situation. You have this one right here, okay? Interest rates are higher than what this face says. This face says 5%, but you're not able to get, look at it this way. If they were issued at 100.0, that would mean that it's exactly at par. It's exactly $2 million. It's exactly what people would be willing to give you for a 5% interest rate. But you're not getting 100.0, you're getting 95.5. So you're getting less than 2 million in exchange for that 5%. That means if they were to give someone else 2 million, they would get more than 5%. That's why they're going to give you less than 2 million, because your piece of paper has 5% on it, and across the street they can get, for example, 6. So let's go ahead and do the math on this. First of all, the first question is, how much cash will Sonic receive when it issues the bond payable? Well, when Sonic issues the piece of paper, uh, how much cash they're actually going to receive really depends on a couple of different factors. The most important one here is that you're only able to unload this piece of paper, this bond, at 95.5. So it's pretty easy. You come over here, 2 million. Let's have a nice green paper. There's 2 million. And what you do is you multiply that by 0.955. Remember, I told you when you see these interest rates, please convert them immediately over to get them out of this percentage. So this 95.5 is like saying at 95.5%. So just go to the left twice. 1, 2 to make it 0.955. And you multiply that out. Multiply out the 2 million and multiply it by 0.955. And that will give you 1910. $1,910,000 is what you can get for that $2 million bond. And that's because people aren't willing to give you $2 million. Your bond pays 5%, right? It pays 5%, and they can go out on the street over here and get more than 5%. That's why they won't give you $2 million, because actual interest rates, for example, might be 6% over here. To keep them over here, to make your bond even competitive, they're not going to give you $2 million. They'll give you this much. So let's go and make our entry. The cash that's received is 1910. Let's make our journal entry now. The journal entry is somewhat simplified by the fact that you're going to receive just this in cash. You're only going to receive 1910 in cash, which does make the entry somewhat easier. So let's go ahead and make our entry. Okay. However, what you're going to have to pay, you're getting 1,910,000. You're going to have to pay the full amount. You got to pay the full amount of 2 million. Okay. The piece of paper. This piece of paper is not joking around. This one right here that we had, it actually says $2 million is the face value of this. Of course, we didn't get face value, but we still have to pay interest, right? And we still owe $2 million at the end of this time period. We owe $2 million even though we didn't get $2 million for it. That's how you get the effective interest rate to be higher. So we come over here. We know, I would encourage you when you make this entry is make the outside first. Make the debit for cash, but that's how much you're getting, which is the face value times 0.955. Bonds payable is what the face says. You're tied to what the face says, which is 2 million. And the difference in this case is a discount. You'll notice that you're below 100%. If we had issued it at 105.5, you would multiply this times 1.055 instead of 0.955. So the discount here is the difference. And your difference is pretty easy. You just take 1,910,000 minus 2 million. That's 90,000. So that's your entry that you make when you actually get your cash, which is less than face, but then you owe the full face, and here's your discount, the difference that you're going to have to amortize. In this fortunate situation, we'll be working this balance down over using the straight line method. We'll cover that more here in a second. So how much must Sonic pay back at maturity? In other words, when the maturity date is, this is July 1st, 2014 is when this is issued. So this is going to mature. The full amount, that big giant number, is going to have to be paid back. We're not talking about the interest month by month, by every 6 months. We're talking about the full maturity value. The 2 million is going to be paid 10 years from this date. And you're going to have to pay the full amount. You're going to have to pay the full face amount. That's the reason you have bonds payable of 2 million. The maturity date, this is one of the easiest ones on here. It's 10 years. This is a 10-year bond. So basically it's July 1st, you add 10 years, and it's 2024. Okay, how much cash interest will Sonic pay each 6 months? Well, every single 6 months, you're going to have to pay the face value. You're going to have to pay the face value of what the interest is times the interest rate. In other words, times the interest rate that's on the bond. So again, here, the interest you're going to pay, you're again tied to this piece of paper. It's 2 million times 5%. Now, where it gets a little tricky is it's each 6 months. Remember that when you see percent, think percent per year. So let's go ahead and do this math right quick. If we have 2 million and it's a bond of 5%, that means that we're going to have 2 million times 5%. Notice that I put it 0.05 instead of 5%. Just keep everything in decimals. It's a lot cleaner. And 2 million times 5% is $100,000 per year. Notice that it's 5% per year and $100,000 per year. Okay? But be careful, this is per year, right? This is per year. And that's not what it's asking you for. It's asking you for what's the payment each 6 months. Well, the payment that you make every 6 months is half of this, so it's $50,000. Number 4, how much interest expense will Sonic report each 6 months? Assume the straight line amortization method, journalize the entries, whatever. Well, here what we're going to do is we're obviously every 6 months, right, we're going to owe $50,000. So let's go ahead and get $50,000 written off somewhere. Let's get rid of this. Here, we'll come out to our brushes. If you look here, we have, get onto the right screen. If you look here, we're going to have interest expense each 6 months. For sure, we're going to owe $50,000. So let's get that out there. $50,000 we're going to owe in interest. We're going to pay that. But our effective interest is not $50,000. This is not the effective interest rate. It would be the effective interest rate if we had gotten $2 million. But remember, we were unsuccessful at getting $2 million. We only got $1,910,000. So we were $90,000 short, right? Well, that $90,000, that's what this straight line method is all about. What we're going to do is we're going to straight line this over 10 years. So we come out here, we take 90,000, divide it by 10 years, and we're getting $9,000 per year. So our effective interest, right, our true interest that we owe in terms of interest expense is going to be higher by $9,000 per year. It's going to be what we pay, which is the face value here, right, the $50,000, but it's also going to have to be increased. Have to be increased by $9,000 a year. Now here's where you need to be careful. Okay, where you need to be careful is you notice we took this $100,000 per year and we chopped it in half. In other words, we came out here and we chopped it in half to reflect a half year. Come over here, we pay interest January 1st and then July 1st. Notice that's every 6 months we're paying interest. And what it's asking you here is each 6 months. So in the same way that we chopped this in half to come up with 50,000, that's what we have right here, 50,000. In the same way we did that, it's important that we chop this in half. Okay, so it's 4,500. The reason it's 4,500 is this is per year, per year, per year. This is per year, per year, per year. Repetition helps. But it's not asking you per year. It's asking you, hey, what is it each 6 months? Okay, so we chop it in half. We get 50,000 and 4,500 for a total of 54,500. This plus this is 54,500. And that's how much interest expense we're paying. We're paying 50,000, but we're suffering 54,500 because we were unsuccessful at getting 2 million. All right, let's make our entry now. The entry, be careful, because the entry here is December 31st. You will notice that we don't pay interest on December 31st. We pay interest on January 1st, and we pay interest on July 1st. We pay interest January 1st and July 1st. So you're not going to pay anything here. This is just the accrual of interest, right? So let's go ahead and journalize our accrual of interest for this time period. So July 1st to December 31st is 6 months, and this just happens to be nice and handy what our interest expense is. So let's get our interest expense in. 54,500. And then I encourage you to do the outside first. The outside is the interest payable. In other words, how much interest you're going to owe on this. Keep in mind the interest payable is how much you're going to end up paying in interest. Okay? Well, we're going to end up paying 50,000. If you remember out here, it is 100,000 per year, but we're doing it, every 6 months. So it's going to be the interest payable, which you truly owe the outside world, is 50,000. And you see you calculated that here. Every 6 months we pay 50,000. And then your difference is your $4,500 here. And that's your discount on bonds payable. You will notice that you set up a debit, a big giant debit of $90,000 for your discount on bonds payable. So when this bond was actually issued, you had this huge number difference, which is your discount. And here you're working it off. And you notice you're working off, this is amortized over 10 years. This is a 6-month portion. So another way to look at this is, if this is helpful, is you're going to pay interest 20 times. 10-year bond, twice a year, 20 times. So if you take $90,000, if this is helpful, I'll point this out, and divide it by 20, you'll have 4,500. Okay, that's another way that this relates to this. The only difference here is we took 90,000, divided it by 10 years, and now we're at years, and then we divided in half to get to every 6 months. And this is every 6 months. Whatever's easiest for you to keep track of, but this is what we have here with the 4,500, which is, we go back down, so you set up the big number, and then you're working it off or amortizing it here with your payments of interest. You truly owe this. You owe what the piece of paper says. Well, I lost my piece of paper there. What you truly owe is the interest payable, and that's how much you're actually paying. Your interest expense is higher because you were unsuccessful, right? You were unsuccessful back here at getting $2 million because interest rates had gone up, and when interest rates go up, your piece of paper is less competitive and you get less for it. But basically this completes your entry, and then you're working this off little by little. Notice that the effect of all this is you're recording more in interest expense, because that's truly what's happening. You're having to pay more because you didn't get the full $2 million, and you're following the rules of the piece of paper. You're paying exactly what the piece of paper says. At the very end of maturity, you're paying what the piece of paper says, and you're paying interest just like the piece of paper says. The only thing is you're working the discount off to effectively make your interest be different. Now I have a quiz for you. Does something look wrong on this last journal entry? What account did we put our discount on bonds payable in? Because this happens quite a bit with students. Okay, I'm trying to prevent you from having this happen. Notice how the discount on bonds payable is a debit. If you had issued it at 100.1 or 100.5, whatever, then it'd be premium on bond payable. You need the entry here. Be careful. I see this on tests all the time. Notice the discount on bonds payable is a debit. It's a big giant debit. Be sure you don't make this mistake. And then when you're amortizing or working off the discount, you make it a debit as well. Please be sure you make it a credit. Okay? Easy mistake to make. Just be sure that when you issue your bond, you follow what the paper says, $2 million. You're getting less cash because you're below 100.00. Set up your huge discount on bonds payable, and then work it off with credits. Please don't work it off with debits. The last entry here, journalize the entry for the payment of the interest. This is not that big a deal. Basically, what you're doing is, making your payment here for interest payable. So finally, now you're on January 1st. Notice you pay interest January 1st and July 1st. Please don't pay interest early. And this is pretty easy. I mean, basically, you got cash, and you basically accrued what you owe in interest for 50,000, and you're just paying it now. And then let's take the interest payable off the books, because now we don't owe anymore that interest payable that we accrued at the end of the cycle, at the end of last time. Please, as you work through these types of problems are practice problems. You've got to do more than one. Even if you do one and you do it right, please don't declare yourself an expert at making these entries. It's really important that you practice and you get into the flow of where it is that you put your discount, whether it's debit or credit, how much you actually owe, the maturity date, which is 10 years from now. Notice that the payments of interest follow what the piece of paper says. This is what the piece of paper says. It says 2 million, 5%. And then when you're journalizing your interest expense is going to be higher than 50,000. Okay? If this had been issued at 100.0, then here you would have no discount or premium. It'd be 50,000, 50,000, and the world would be a very, very nicer place. And then the interest payable, again, follows what the bond certificate says on it. I hope you found this useful.